do it. Okay? All right, chapter 6. So let's look at our big picture facts here. We're going back to Dr. Payne. We talked about Dr. Payne before. He's the dentist. These are his deductible, or his potentially deductible expenses that he had in his dental practice last year. Salaries of $120,000, rent of $24,000, depreciation of $52,000, insurance of $22,000, dental supplies and office supplies equaling $19,000 total, investigation expenses of $6,000. He had some contributions to some campaign funds, some legal expenses associated with a lawsuit, fines imposed by the city for improper disposal of medical waste, some dues paid to the dental society, and a draw for living expenses. You will remember when we talked about partnership tax very briefly, we said that in partnerships, often the partners receive a draw throughout the year. And a draw is really the same thing as a distribution, okay? It just comes before that income has actually been allocated. Okay? Okay. So, let's talk about deductions, which will be the focus for a while. Remember when we talked about income? We said gross income includes all items from whatever source derived unless there is an exception, right? Income includes everything. Deductions work just the opposite. There is no deduction unless it's specifically stated in the code. So, and that's what it says on this slide. Deductions are based on legislative grace. That means Congress has decided that you get to take a deduction. Very often you see deductions as a way to influence behavior. Congress says, you know what? We think that contributing to a charity is good. So you can take a deduction for this contribution that you give to charity. Or we think that saving for retirement is good. So if you put money into an IRA, you can take a deduction for that. There are certain behaviors that Congress thinks is good, and as you can imagine, it changes over time. Things that they think are good, so they give out deductions for it, or things that they think are bad, and you have to, not get a deduction or get a reduction or something like that. Okay? With deductions, there is a substantiation requirement. That just means you gotta prove it. Okay? So, depending upon what type of deduction you're taking, the substantiation requirements may be different. So if you have mileage you're trying to take, you need a log saying, okay, I'm going here on this date, I'm going this many miles, and this is why I'm going. If you go buy a printer at Best Buy, you need a receipt. Okay? Depending upon what type of item you're looking at, if you have remember, I think we talked about this when we talked about meals. We said if you have a meal with someone, you need a receipt. It doesn't have to be a receipt. Some sort of documentation saying, I spent this much money on this day with this person, and we talked about business. So there is different documentation depending upon the deduction. We're not really going to talk about substantiation that much in this class, but you just need to know it is there. You have to have documents. My husband owns his own business, and he's not very organized. And we've had to come up with this system where he can essentially file receipts in his car. So we have a filing system in our car. Because once they made it to his pocket, there was no telling where they would leave. Probably end up in the dryer. So sometimes you'll have clients come in and they don't have any receipts for anything. Technically, you can't take the deductions unless you have some sort of documentation to back it up. Okay? Okay. Now, as we have said many times, there's let me see if I have another marker. There are above the line deductions and below the line deductions. This book calls above the line deductions for AGI, and then we have below the line, which are from AGI. Even worse. Okay. So, I know we have talked about this before. An above the line deduction is basically a deduction that's on page 1 of the tax return. Okay? And if you're looking at a tax return, which someone asked me in the last class if they could bring a blank 1040 onto the exam, and I said sure. So, if you'd like to do that, if that helps you out, you can, and it may help you out. So if you're looking at a 1040, line 37 is your adjusted gross income. Okay, your AGI. If you have a deduction and it is on page 1, anywhere on page 1, it is an above the line deduction because it goes toward the calculation of adjusted gross income. What are some things that do not go toward the calculation of adjusted gross income? Anything on page 2, okay? Which includes below the line deductions, exemptions, credits, fringe. Okay? So how many exemptions you get is not relevant for calculating AGI. Whether you take a standard or an itemized deduction is not relevant for AGI. Okay? So in AGI, the number AGI is very, very important. If you are doing a tax return, your AGI is, you need to make sure you've got AGI right. Go back and check it many, many times because your AGI is used for so many other deductions and credits to determine what the limit is. For example, there's an example up here on the board. Medical expenses, which are an itemized deduction. You can only deduct medical expenses to the extent they exceed 10% of AGI. Okay? That's a lot, right? That's a pretty big number. So in order to take a deduction for medical expenses, they must be greater than 10% of AGI. So your AGI is very important for this deduction. And lots of other deductions and credits out there are based upon your AGI. So it is very, very important that AGI is calculated correctly, or you are going to have a lot of other wrong numbers. Okay. So, let's talk about some deductions that are for or above the line. And if you look at slide 8 and slide 9 and 10, I believe, it lists out some things that are above the line deductions. They also have, on page 6.4, they have Exhibit 6.1, which lays out some common above-the-line deductions, okay? And really, I mean, if you're looking at a 1040, like I said, if it's on page 1, it's above the line. So you can take a look at your 1040 and say, okay, let's see, we have IRA deductions, line 32. Line 33, student loan interest deduction. Well, those are all listed on page 1. So they're an above the line deduction, okay? And these are some above the line deductions here. Trade or business expenses. Reimburse employee business expenses. We're going to come back to these two right here in chapter 9. We'll have an extended discussion on that. That is all chapter 9 is about, is business expenses. Deductions from the loss or exchange of property. Deductions from rent and royalty income. Alimony. Half of self-employment tax. If you guys remember, we talked about self-employment tax a couple weeks back, and we said that there's an employer portion and an employee portion of employment tax. The employer portion is approximately like 7.5%, something like that. It changes all the time. So 7.5%, something like that. And if you're self-employed, you pay both pieces of it. Okay? But you do get to take a deduction, an above-the-line deduction, for this half. Okay, if you're self-employed. I'm talking about this now because we really probably won't get to that chapter where we talk about this in detail, so I'll mention it now. But it's pretty simple, really. The person who's self-employed gets an above-the-line deduction for the employer portion that they're paying. Alimony. 100% of health insurance premiums paid by someone who is self-employed. Please note, you have to be self-employed to take an above-the-line deduction for health insurance. It's not actually on this form, but it is on Schedule C.
So if you're a partner, are you self-employed?
No. If you're a partner in a partnership, you are not self-employed. You are employed. I mean, well, technically you're not employed by the partnership, but you get your income from the partnership. So the partnership will take a deduction, basically, which will be passed through to you as a partner. Okay? But in this class, if you own a business, right, you have Schedule C or Schedule E income. So in this chapter, we will talk about Schedule E, which is for rent and royalties. Okay? Schedule C is where sole proprietors, or people that are self-employed, report their income. If you're a partner in a partnership, you do not report anything on Schedule C. Okay? All right. Contributions to IRAs, and you can definitely see line 32 says IRA deduction. Penalties on premature withdrawals from time savings accounts, moving expenses. Moving expenses is somewhere on here. Line 26. So, let's see. Interest on student loans. That's on here. Line 33. Qualified tuition and relating expenses under 222. That's line 34. Up to $250 for teacher supplies for elementary and secondary school teachers. College professors do not get this $250 deduction. Okay? So these are your above the line deductions. And yes, some of these deductions have limits, which we're going to talk about. Okay? But these are the above the line deductions. Now, let's talk about below the line deductions. We will go in detail on below the line deductions later on in the semester. The last, couple weeks of class, we'll talk about it below the line deductions. Last, a little bit, anyway. So, but these are your below the line deductions right here. You will need to have some working knowledge of below the line deductions to do this sample assignment from chapter 6. It is very simple use of below the line deductions. And your 1040 assignment that you have to do for this class, you will have itemized deductions in that assignment as well. And you will have to go through these itemized. So like I said, these are a good thing just to memorize. Medical expenses, state and local taxes, contributions to qualified charitable organizations, personal casualty losses, certain personal interest expenses, and some other miscellaneous itemized deductions, which are things like gambling losses, things like that. Okay. Next topic we are going to talk about, let me get to my notes. Is code section 162 and code section 212. Okay? These are important code sections. These have to do with deductions from a business. Okay? There are two standards. There's a standard under 162 and a standard under 212. To have a deduction under code section 162, the deduction must be ordinary, must be necessary, must be reasonable, and must be for carrying on a trade or business. So all of these items are not really defined in the code. They have been defined via lots and lots of case law. Okay? So if some of you are planning on a career in tax, which hopefully some of you are, because there is a huge demand for tax people right now, okay? You will have to read cases all the time, okay? People think, oh, well, I'm going to be an accountant, lawyers read cases, why would I be reading cases? Well, if you're doing research, which honestly, if you're a CPA and you're doing tax, a lot of your job is going to be research, not actually preparing tax returns. So you will be doing a lot of research because there are always unanswered questions, a lot of ambiguities and grayness in tax, which is what makes it fun and is what makes you get paid a lot, quite frankly. Okay? So if you're doing research, which you will have to do lots of research, you'll have to read a lot of case law. And this is one of those areas that is largely governed by case law. Okay? It's not really in the code or the regs, not much. So let's talk about these things. What's ordinary, what's necessary, what's reasonable, and what's a trade or business. Okay? Let's talk about ordinary first. Ordinary means normal, usual, or customary for others in a similar business. That does not mean reoccurring. Okay? Ordinary does not mean ordinary to you. Okay? Like something, oh, I pay rent every month. Okay? Which, that would be ordinary. But I'm saying it doesn't have to be something that you do on a regular basis. Okay? Something that's reoccurring. It can be something you only do once during the lifetime of the business. For example, let's say you get sued for sexual harassment and you have to pay for an attorney to represent you on as part of your, business, okay? Well, hopefully that's not something that's reoccurring, okay? But it is probably would still be considered to be, some sort of ordinary business expense, so long as it incurred in the course of the business, okay? And in fact, the book gives an example of paying for an attorney, an example for some sort of fraud that went on, and they had to pay $30,000 in legal fees. Well, these don't happen all the time, but they're still considered to be ordinary because someone else in a similar line of business might have to pay these expenses. They're not reoccurring, but they're still considered to be ordinary. Okay? Necessary, it has to be a requirement for the business. The test is a prudent business person would incur the same expense. So someone else in the same line of business would also consider this to be a necessary expense. Reasonableness is really a question of fact, okay? That means that honestly, when the IRS is looking at what's reasonable, they'll go and they'll get comparables and they'll say, okay, this is how much this company paid for X, so this is what is reasonable, okay? And then the last one, incurred in the conduct of a trade or business. So this one, what they look at to determine if it's a trade or business, because that's not been something that's been readily defined. They kind of look at two things for trade or business. They look at profit. Is there a profit motive in the business? And two, what's the involvement of the taxpayer? Is this the taxpayer's only job? If so, they're very involved in the business. Are they trying to make money, or this is really just, because they like to do it on their spare time? Like scam killing. Okay? And this involvement of the taxpayer is really important for determining the difference between 162 and 212. So a 112 expense must be ordinary, must be necessary, must be reasonable, okay? But is not incurred in the trade or business. It is incurred in the production or collection of income. And there must be a reasonable, I'll just say proximate relationship. This is important for 212, and this is why. Some students get confused on the difference between Code Section 162 and 212. The difference is really this right here. Okay? 162 is a legitimate business. It's taking up most of your time. This is all that you do for your livelihood. Code Section 212 is a lesser standard of involvement. Okay? You see 212 a lot with things like stock or property investment. With things like rent and royalties. Okay, these are some things that you commonly see with Code Section 212. Okay? 162 is really your legitimate, regular business. Okay? You're operating it for profit. This is your full-time job. This is what you do. Okay? 212 is where the owner or the taxpayer is not really as involved in the business. They still want to make money, okay? But they have another job on the side, okay? This is not their primary source of income here. And a lot of the things that people talk about that come up with 212 is, like I said, stock or property investment, rents and royalties, yeah.
So like for like venture capitalists, if you have like stakes in another company, would it just be off percentages? Like how much you own in another company?
Well, that's a little bit different because now you're getting into partnership tax questions, which is governed under subchapter K, which is different. So there are different rules for partnership tax. So, no, we have different rules, okay? We're talking about sole proprietors in this class, right? So people that own their own business, they report on Schedule C, okay? Not partners in a partnership, which have an entirely different set of rules in code, which quite frankly are unlike anything else that's out there in tax, okay? So, why does it matter? Why do you care if you're under Code Section 162 or 212? Well, if you fall under Code Section 162, you get an above-the-line deduction. Ooh, that's good, okay? Taxpayers almost always want an above-the-line deduction. Why? Because you get them no matter if you itemize or take a standard deduction. Everybody gets an above-the-line deduction, and they're not subject to as many limits as itemized deductions. What happens if you have a Code Section 212 deduction? Okay? It is either above or below the line, depending. It depends. It depends upon the type of investment or the type of item. So if we look here, these are the 212 expenses that are above the line deductions right here. Expenses related to rent and royalty income, which we are going to talk about in detail in this chapter, probably next week. No, I mean on Wednesday. Okay? Expenses paid by sole proprietor for determination of taxes. This is interesting because if you're a sole proprietor and you own your own business and you pay a tax advisor to prepare your taxes, you get an above-the-line deduction. But if you're not, you don't own your own business or you don't have rent or royalty income, then you actually can get an itemized deduction for it. And it is subject to limits. Okay, there's just another example showing you why people prefer above-the-line deductions. Same item, but because this person owns a business, they get an above-the-line deduction for it. Some 212 expenses are itemized. You see this a lot with investment-related expenses, like you pay your stockbroker some fees or your financial advisor, you pay them some fees. That is an itemized deduction. Okay? It's still a 212 deduction, but it is below the line. Okay? So depending upon what type of item it is, it may be above or below the line with 212. And there must, with 212, we do have this requirement that there be a proximate relationship to the production of income. So if you look in example 5, this is a good example of this on page 66. Debbie is a retired pilot who owns a small portfolio of investments, including 10 shares of Robin Inc., a publicly traded company worth $1,000. She incurred $350 in travel expenses to attend the annual shareholders meeting where she voted her 10 shares against the current management group. So here, they said, this is based off an actual court case, okay? No deduction is permitted here because she only had 10 shares in the company, and the value of those 10 shares, or $1,000, is insignificant compared to how much she spent on travel. So in this court case, they said that the expenses that she incurred were not proximately related to the production of income, because they were essentially 35% of the value of her investment. It is a very subjective, wishy-washy standard, which I know you all hate, okay? But that's life. So, now one other thing I want to mention that is covered in this chapter. There is something called a hobby. This is things like gambling, racehorses, stamp collecting, antique car collecting, things like that. If you have something that's a hobby, it may or may not even satisfy the threshold for Code Section 212. Okay? We will talk more about hobbies, but you should list it, on your list. Hobbies, if it really is a true hobby, okay, then you can take an itemized deduction, but only to the extent of hobby income. So I say this because these are the different levels of involvement that are required for a business deduction. We have Code Section 162, which is complete involvement, above the line deduction for business expenses. We have Code Section 212, which is involvement on more of an investment basis, okay, not an active role in management. This is above or below the line depending upon the type of item. Then we have hobbies, where if you have something that is classified as a hobby, okay, you can take an itemized deduction for the expenses from your hobby, but only to the extent of hobby income. Okay, so these are really your different levels of involvement, your different levels of profit seeking. Okay? Now, as I just mentioned, we are going to have a whole chapter, chapter 9, where we talk in depth about this code section and all the deductions that might fall here. Okay? In this chapter, we are really focusing on Code Section 212. So this lesser standard of involvement. And we are going to talk about rent and royalties, probably in the next class period. We're going to talk about investments. We'll talk about some other above-the-line deductions and how they are limited. And we're going to talk about hobbies in this class. Okay? For the most part, in this chapter, sorry. For the most part, if it falls under Code Section 162, just sit on it. We will come back to it after the next exam. Okay? But it is important to talk about it now because I want you to see the difference between Code Section 162 and Code Section 212 in hobbies. We'll talk about what is a hobby in the next class period. Okay? So these are the different levels of involvement and why you care which category you're put into. Now, I want you to take a look. I'll mention this briefly too. Okay? I have said this before, but I'll say it again now. There is no deduction for personal losses. So if you sell your house, you sell your car, okay, there is no deduction for that. Now, if you have a business property that you are selling, or an investment property, like a piece of stock, you can take a loss for that. Okay, but if it's a purely personal loss, there is no deduction. Now, there are some exceptions out there. One up here is on the board, casualty losses. These are things like your property. I love when they have shipwreck up here. These are things like your property is stolen, it's destroyed in a hurricane, it's taken by pirates, I don't know, okay? That is considered to be a casualty loss, and you can take a deduction to it subject to some limits. That's an exception. There are some other exceptions out there. I mentioned this because all these are discussed in Chapter 7, which unfortunately due to time we're skipping. So I just draw this to your attention. So if you see it in practice or you're studying for the CPA exam, you know it exists, you know it's out there. Please know it is in Chapter 7 and we have skipped it. Okay? We're skipping the chapter on losses. Okay, now I want to talk in the last 5 minutes. I have an appointment I have to get to, so we're going to have to end class a little bit early. Sorry. So, but I want to talk about Exhibit 6.2 on page 6.7. This is an important exhibit and quite frankly something you need to memorize. Okay? If you're studying for the exam in this class or the CPA exam, really this is just the kind of thing as a financial advisor or as an accountant people expect you to know. Okay? Whether you do taxes or not. These are the different schedules involved in 1040. There aren't that many of them, 6 or 7, okay? So if you look, these are the different schedules, and this chart's pretty good. It really is good. It shows you not only the different schedules, but it shows you where they tie in on the 1040. And if you look at this chart, Schedule B, C, D, E, and F all tie in to page 1. What does it mean if it ties to page 1?
It's an above the line.
That's right. It's an above the line deduction if it's a loss, right? Okay. So, or it's just income, right? Because all income is reported on page 1. It's either income or an above the line deduction if it's on page 1. Those are the only options if it's on page 1. Okay? And then we look down here, Schedule A. So what's Schedule A again? Itemized deductions. Itemized deductions. Okay? So, Schedule A. Itemized deductions. Some things that tie in to Schedule A. I'm going to write some forms up here. This is not the kind of thing you need to memorize, but these are some major forms that you will see that tie in to Schedule A. Form 2106, which is for employee business expenses. Little hint, you do have to file Form 2106 in your actual tax return assignment due at the end of the semester, not our practice one that we're doing next week. Okay? Another form that you commonly see, 4684, which is for casualties. Just talked about that, casualties. Another form, 4952, which is for investment interest. Another form, 8283, which is for non-cash charitable contributions. Note, this is only for non-cash charitable contributions. Okay, if you have a purely cash contribution, you do not need to file this form. Okay, We next have Schedule B, which is for interest and dividends. There aren't really any major forms for this one. In fact, this schedule is really pretty simple to fill out. For our sample assignment we'll work on next week, there is a Schedule B that has to be done. Honestly, this schedule is really simple. You just put the name of the stock, what your basis was, what your proceeds were, or actually you don't need basis for stock. You just get a dividend. How much of it is qualified, how much of it is not qualified. Sorry, I'm thinking of Schedule B. But B is really simple to fill out. Okay, Schedule C, profit or loss from a business. This is a big one, okay? You'll definitely have to fill out a Schedule C with your 1040 assignment at the end of the semester. Not your sample one, because we haven't talked about it yet, and we will not talk about it in this chapter, okay? Schedule C, profit or loss for a business. You could have Form 8829, which is for business use of your home. Little hint, you will have to fill out Form 8829 with your 1040 assignment at the end of the semester. Okay? And honestly, it is not the easiest form to fill out. Okay? Once you read it, it is definitely the kind of form you need to read in detail. And you need to read the instructions in detail. There are definitely some ways to screw this form up. I have screwed it up before. Luckily, I figured it out before I filed it with the IRS, but you can screw this form up. It's a little bit finicky. Form 4562, which is for depreciation. We will be talking about depreciation in detail in Chapter 8. The entire chapter is on depreciation, which will be the chapter immediately after this one we're talking about. Okay? That's pretty much it as for the major forms for Schedule C. Schedule D, which is for capital gains and losses. Also, not a very complicated form to fill out. You just put the name of the company, what your basis was, your proceeds, and your gain, whether it's short-term or long-term, etc. It may be long if you have a lot of stock sales during the year. Okay, you may have a lot of things you have to enter, but in general, pretty self-explanatory. Probably don't even have to read the instructions. Okay? There are some forms that tie into this. Form 4797, which is for sale of business property. The reason why business property has a separate form is because you often take depreciation on business properties. Okay? And as we will learn soon, anytime you take depreciation on a property and you later sell it, you have to go back and recapture that previous depreciation deduction as ordinary income. Okay, the IRS gets you, right? You get an immediate depreciation deduction, but later when you sell it, you have to recognize that depreciation as ordinary income. It's called recapture. Okay? That's why we have a separate form required for 4797. Then there may be a form, commonly see, 6252 for installment sales. This is if you have a sale that is paid over time. You would file this form 6252 to manipulate the timing, basically. Schedule E, you may have a Schedule E, which is for rents and royalties or other supplemental income. Okay? Remember? Well, look on that chart. Schedule E and Schedule C, D, and B all flow through to page 1. Okay? Which is why we say if you have rent or royalty income or deductions, yes, it is a 212 expense, but because it shows up on Schedule E, it flows through to page 1 and is an above the line deduction. That's how we get there. We have a 212 expense related to rent. It shows up here, which is pulled to page 1. Okay? So Schedule E, rents and royalties. You may see Form 4562 for depreciation again. You can have depreciation here. And lastly, Form 8582 for passive losses. There are some limits on losses from passive activities. Okay? You'll see this in Form 8582. Those are the major forms. There are others, but these are the major forms that you would see on a 1040. Oh, there's one other schedule. I'm not going to write it down. Schedule F, which is for farm income. I don't talk about farm income in this class. For one thing, it's not in the book. Okay? But Schedule F is farm income. I found out last semester that actually a lot of people around here, including my students, live on farms or own farms, and they were asking me questions about like deductibility of their chicken coops and whatnot. I have no idea. That's not covered in the textbook. I would have to research it. So we do not cover farm income, unfortunately. This class, if you live on a farm, sorry, you'll have to ask your tax advisor, which is not me. Okay? All right. All right. Thank you. We'll see you next time.
Let me